What was the first deal that kind of like tipped the scale for you where you felt like, okay, now I'm somebody that people should trust?
So I'd say I remember having a feeling within 3 years and certainly 3 to 5 years that, okay, now I understand that component of this business and therefore, can look that much further into the future of the next client that I'm helping. And I'm trying to think of a specific deal, but it was around that time, probably somewhere between 3 and 5 years. In the beginning, you're just kind of at the mercy of the players that know what they're doing.
Today's guest is Sean Worl. He is a vice president at Colliers and leads the multifamily group here at the Portland office. Sean, really excited to have you here. You've got a lot of knowledge when it comes to multifamily brokerage. You've done deals big and small, and you've been at it for a while. So I think you're going to be a great resource for people listening who want to invest in multifamily in particular, and really just understand that landscape and what it takes to build a relationship with a broker like you, and really just get your expert opinion. So thanks for being here.
Nick, thanks for having me. It's good to be here. I know we tried to set this for a couple months now, so glad we got it done. Excited to share what I know.
Perfect. Yeah. Well, you're a busy man, so I forgive you, but you're here now, so that's what matters. But before we jump into kind of some of your thoughts and so forth, maybe you could just tell us a little bit about how did you get into multifamily brokerage? Obviously it's not something you probably grew up wanting to do. So tell us a little bit how you got started and, what got you onto that side of the business?
I've been asking myself that for a number of years. How did I end up here? I got licensed in 2007. It was kind of a continuing education piece as I was going to Lane Community College at the time. And I knew I wanted, good old Eugene.
Yeah.
I knew I wanted to get into real estate and really was in love with the idea of creating and building, and so developing real estate. And was working with my dad. We were doing small kind of fix and flip houses in Longview and up in Clark County. Mm-hmm. And he sold a 5-plex and bought a 12-plex in 2008. So I got some experience renovating, was doing labor at the time. So a lot of my amateur carpenter skills got their start there.
Yeah, sweat equity.
Indeed. And so, 2010 is about the time we were graduating. That's how we met. So we met at Portland State through the real estate finance program, and not a lot of developers were hiring. I interviewed every single one, told them I was going to Portland State and the real estate finance program, and how do I get into development? And they all said, you don't right now because nobody's hiring, and you don't have a project management background. So I got some really good recommendations from some of the known names in the development world here to get into brokerage, to learn. You're going to see a lot in brokerage. You're going to learn the trends, and you'll see how eventually you see how kind of everybody ticks and what builds their business plan different from others. So that was their encouragement. I had already had my license. Nobody else was hiring except Marcus and Millichap. Shout out to them. They had the training program. I just happened to have a friend who worked there. So I ended up interning there for 6 months while I finished the degree in real estate finance, and then decided I'm going to go for it. It was that or going back to selling men's sportswear at Macy's. And it's like, why not invest in this? So
sure.
I did it. Didn't make any money for the first year. Slowly but surely
started
making money. That's right.
Yeah, that's how you start out. That's always a challenge. So, obviously you survived because you've built a career in that industry. But a lot of times, when you do your first deal, it's a milestone, but oftentimes it doesn't really check a box because you're kind of like, well, I got one under my belt, but maybe it's not what you wanted to have accomplished at that point. Maybe you could just tell us about your first deal where you felt like, hey, now I'm credible. Now I'm somebody that I can, when I cold call someone or I pitch somebody and they ask if I've listed property before, I can throw this gem out and feel confident. What was the first deal that kind of tipped the scale for you where you felt like, okay, now I'm somebody that people should trust?
Yeah, God, sometimes I still feel like I'm reaching for that, depending on the size of deal. But
Comes with age, though. I feel like the older you get, the less you know. Right?
Yeah, that's true. So I'd say I remember having a feeling within 3 years, and certainly 3 to 5 years, that, oh, okay, now I understand that component of this business, and therefore, can look that much further into the future of the next client that I'm helping. And I'm trying to think of a specific deal, but it was around that time, probably somewhere between 3 and 5 years. In the beginning, you're just kind of at the mercy of the players that know what they're doing.
Sure.
And you're just kind of getting, totally. You do your best to get a listing, or to find a buyer, and then, you match that with a seller or vice versa. And then you basically just get ordered around until the deal closes, and you're just like, what is going on in the process? And so, yeah, in that, I feel like there's every 3 year, there's a milestone where you just learn that much more just by beating your head against the wall, trying, learning, listening, asking questions.
Yeah. And now you have the benefit of, obviously a lot of experience, a lot of transactions. And, one of the things that's interesting in multifamily, and I think this is probably true in commercial at large, not as important in residential, though a factor, but, how much does reputation of the buyer, but also the broker, play into getting offers accepted? Because sometimes people will accept an offer that maybe the price is not as high as somebody else. There are other reasons that people would accept an offer. And so just from your perspective, how much does the reputation of the players, the buyer, and you as the broker representing them kind of play into a seller's decision to accept an offer?
It depends on so many components, one of them being demand, and a primary one being demand. If there's one offer on the table or 10 offers on the table, there's a whole slew of different factors that are at play. If that's the only offer, doesn't really matter what the reputation is. It's just, do you think that there's a pot of gold at the end of the rainbow for going down that road with them, going under contract? If you are in a scenario where, let's say, there's a handful of offers and one of them has a reputation of closing and one of them doesn't, that's a pretty big indicator. What's the difference in their pricing? You have to vet out, if there's a lower reputational, buyer with a higher offer, well, talk us through why you walked out on these other deals, and why we should think that your offer way over everybody else is worth working with. But it matters, and it's a small industry, and it's a small, certainly within our region, it's a small, community. So reputation certainly matters. Yeah, I mean, just no, that plays a component for sure. If you have a reputation of closing, that's a good reputation to have.
Sure.
Yeah, for getting things done.
Have you ever been in a situation, though, where like maybe you've got a buyer who's maybe newer to the market, and you hear some pushback from the seller, and you're just like, hey, I can vouch for this person? Have you ever had to do that and say, hey, I think this is a credible person you should consider?
Yeah, absolutely. Yeah, there's always a million different factors, and your opinion is usually what your clients are looking for to guide them to meet the goals that they need. So yeah, if there's some extenuating factors, you can certainly, put that in and say, hey, I think we should go down this road because, with that said, let's be aware of these other concerns that you might have.
And so, and again, this is more true in multifamily and commercial at large, compared to residential. Whereas, residential, it's really common that the buyer and seller are represented by completely different brokers. It's very common. In commercial, less common, right? You've got people who are doing both sides of the deal. Dual agency is, what it's referred to. What percentage of transactions do you do? Would you say are dual agency versus not dual agency? Like, if you just had to guess.
Yeah, we do specialize in seller representation. And so I would say broadly 75% of our transactions will represent both sides of the transaction. Mm-hmm. We do some select buy-side representation, and it's just, you hit it. It's a more common factor in multifamily for a number of reasons. If there's a deal that people really want, they're best suited to work with the listing broker. If it's, inherently in demand, if there's more than one buyer there, adding another broker who doesn't know the seller's needs and timeline, it just adds another link in the telephone game. And these deals can get very complex. So the more links in the telephone game leads to just a lower probability of closing. So that's a component, and that's, I think, the biggest component. Everybody talks about double ending a deal, and of course, who doesn't love getting twice, value?
Sure, yeah.
But nobody gets paid if the deal doesn't get closed. So it really has to do with the ability to execute and confidence that, you can take this thing all the way through the hurdles that are coming to close the deal.
Yeah, and that's a unique skill set, and I think some people do that well, others not as well. I've definitely been aware of some people who haven't maybe managed that as well. And what I'm getting at is someone's kind of obvious probably comment that, who's not familiar with that kind of arrangement might come to you and say, well, how do I know you're representing my best interest, right? How are you going to remain a fiduciary to me, but also a fiduciary to this other person? How do you respond to people who kind of raise that concern about that sort of dual agency relationship?
I'll respond eloquently and then bluntly. Well, maybe just bluntly. I mean, it's a big boys world, and girls. It's a big. You're assuming that you're working with accredited investors at a certain level.
Sure.
We don't necessarily check for that. It's at the end of the day, the buyer is the one making those decisions. They're the ones that are signing, the buyers and sellers. They're the ones that are signing these documents. And in our state, in Oregon in particular, it's caveat emptor, it's buyer beware. So there are no seller representations. You need to be confident that you're going to go in and do your due diligence. In terms of like proper representation, yeah, if you're new to investing and you lack that confidence that, I know what I'm doing here, and I'm going to be the one that's vetting this out and taking this, from beginning to end, then it could be more of a concern. Most buyers in multifamily at least have one or two other multifamily properties.
Sure.
They've been around the block. They've seen, things here and there. So and then at the end of the day, it's just, you may very well be not getting the best representation, but you're getting the deal. And what's more important, getting the deal or not, getting every last penny, or ultimately buying this asset that over the next 20, 30 years could reap these significant benefits to your family.
Sure. And, and I've noticed this has happened, for me in some transactions I've done. I obviously don't focus on multifamily for sales. It's something that we really don't even focus on. It's just something we do with existing client base. But, I hear things from other brokers sometimes that I am surprised they've told me during transactions. I'm like, wow, I don't know if your client would approve you sharing that information. And sometimes it may not even be intentional. Sometimes it's just they say something, but it's enough information that it changes some of the decision-making process or the consulting that I'll give to my client, which is oftentimes a seller. I don't really work with buyers. Have you noticed that happen at all, where you've gotten pieces of information, either intentionally or unintentionally, that you felt like, hey, I can use this?
Yeah, and I've been on both sides of that situation where there's a fine line between, honestly disclosing a motivation, like why are we here talking about selling this asset?
Sure.
Well, if I, make up some story or just refuse to say anything, it adds to an air of that something's being hidden.
Yeah, lack of transparency.
And so now as a buyer, you're going to be like, well, what the hell else are they hiding?
Yeah.
I need to look at this extremely thoroughly. So, certainly things that are public record but may not be readily available. Again, it's a pretty small community. The people that are looking at most assets are very intelligent. They have access to resources to dig in to find out. If it becomes something that someone's like, ooh, I know this, piece of information, I'm going to hold it over your head, that's usually a buyer that we just advise not working with. And again, it depends on how many other offers are there, how much leverage does each side have. But yeah, I mean, generally speaking, we try to take more transparency than less. Just, this is the situation. This is what we're working for.
Yeah. Well, another question I have, because again, a lot of people, they're familiar with residential, maybe not as familiar with commercial. When you're dealing with commissions on the multifamily side, what it typically is like a range that is within the industry that you see? I know that obviously can't get into specifics, but what would somebody expect if they're underwriting something, what should they factor for as a cost of sale and things like that?
It's so funny because we got into this, I feel like at the tail end of the generation that didn't have transparency and the internet and communication links that are so much better.
Yeah.
So, if you ask somebody that 10 years ago, they would say some outlandish numbers. Usually 6% in the 1 to 3 million range. It's understood, or it's stated that you would compensate a buyer out of that. So a separate buyer is not paying a separate fee. A seller doesn't pay an additional component. Sure. You're sharing 2 to 3% of that, depending on, how much do you need that buyer broker to get it across the finish, or how much work did you put into it, et cetera.
Sure.
Over 3 million, up to 10, it depends on the complexity of the deal and what you negotiate with the seller. It's all negotiable.
Yeah.
Could be 10%. For land sales, I've seen that. Maybe not necessarily 10, but high. And then beyond a certain point, it's usually capped at a certain amount. 250, 300, something in that range.
So it's like a percentage and then a flat amount, whichever is greater or whatever, or less, whatever, I guess, if it's capped. Okay. Yeah, that's cool. That gives some context for what people might expect. Obviously, like, relationships matter. We touched on this a little bit. For somebody who's new to the market, let's just say, and they're trying to build a relationship with brokers, how would you recommend somebody do that? And I imagine there's probably two different approaches depending on their level of experience. There's the person who's never bought anything before and wants to talk to, or maybe they've bought something, but they've bought like a couple fourplexes, let's just say. And then you've got somebody who's maybe much more seasoned and financially well-resourced. Like, what would be your advice if you had a client that was like, hey, John, love working with you, but I'm going to be buying something in, some other state that you don't work in, you don't know nobody in. Like, how should they go about building that relationship?
Yeah, I've seen this done in a lot of different ways, and I would recommend a couple prong approach. One, identify who the active deal makers are. The top 10 list, the 5 or 6 that are extremely active, the handful that are, sometimes active, or you see their name on deals that you would like to buy. Reach out to all of them as often as you think wouldn't annoy the heck out of whoever you're reaching out to.
Sure.
And I think the main thing is conveying confidence. If when you talk to that person and they show you the off-market deal, or they talk to you about the listed deal, as a broker, you're reading from the buyer, is this somebody that can and will close the deal or not?
Yeah.
Do they have the funds? Do they have the know-how, the capability? And it's probability to close is kind of a constant metric. And so I think conveying, conveying that on a deal that you can't actually do that on as a buyer, wasting time, not a good thing to do. Goes to the reputation factor. But the deals that you want to buy, stating that adamantly, yeah, we're gonna be the ones to walk this through. Barring any major catastrophe, assuming it's listed at a price that's in the realm of reasonableness. Yeah. Then just being kind of steadfast and being like, yep, we got this, we're good. You see the small deferred maintenance. Hey, we have that budgeted. We can handle that. When the big items come up, let's find the path to, correctly mitigating this, not blowing it up into a massive retrade that, waste a bunch of time. So, yeah. And then I think one other component to add to that, and we always say this to people, when they used to all be moving to Portland, we still have some come in this way, but not as many. It's go for a double on your first deal. We saw a lot of groups come in.
Baseball analogy.
Yes, try to hit the grand slam, and they pencil everything, and they waste a bunch of time, and they ultimately just turn down a lot of deals that depending on market timing. The market would have made them grand slams, but just underwrite it to a solid double, get on base, because as soon as you come out as the buyer of that comp, you're going to start receiving phone calls, and then the snowball can happen. So yeah, don't be too greedy, I guess, on the first one, or try to hit the home run. Just make a solid play.
And, a lot of times, again, I'm contrasting this for people with residential because that's where a lot of people have familiarity. A buyer broker is going to say, hey, where's your pre-approval letter, right? Do you have an equivalent? Do you say, hey, I want to see some liquidity, or I want to know who you're getting? Like, do you do that before you go shopping with somebody? Is that a process, or how does that look?
For buyer representation? Or when we're vetting out buyers?
Well, I would imagine if you're vetting out a buyer, you're definitely wanting some of that stuff because that's kind of part of credibility of the offer, right?
Mm-hmm.
But maybe if I know that you don't do a lot of buyer representation, but you're familiar with how that works. So what should somebody who's wanting to buy expect to be asked for?
Yeah, proof of funds, not only for the earnest money deposit, but for the down payment. Or, where are you going to access this? What list of friends and family are you going to raise this with? And then, track record, case studies, list of REO. If they have a large portfolio, you can kind of do the backwards math on
real estate owned.
The debt is. Yeah. But yeah, proof of funds is kind of the big one. And usually if someone's making an offer, you can identify who they are, what they are. And then if it's a big question mark, like, can these guys perform, then get more information out of them. And I think the higher you go, you'll have full-on buyer interviews. There'll be lists of questions. You'll ask them about, their underwriting notes, their strategy on, how they're going to execute, if interest rates change 15, 20 basis points in due diligence, how does that, what have you underwritten in terms of change in interest rate environment?
Got it. Okay. Well, that makes sense.
Giving away all the secrets here.
Well, that's what we want. That's why people are listening.
That's right.
They
Go
want
buy
all the
stuff.
secrets.
Go buy some multifamily. Be good landlords, though. Do it the right way.
That's right. Exactly. Speaking of landlords buying and underwriting and so forth, how much, I guess, help as a broker do you provide clients with underwriting their deals, whether it's a seller or a buyer, because somebody who doesn't have a lot of experience, they may not know how to factor for what is property management cost, or how to budget for things that are maybe even more complex, like CapEx, right? Large expenditures. So at what level of participation do you have in underwriting? Is it something where you're kind of working side by side, or you just provide a review, or maybe you could talk a little bit about that?
Sure. You do more of that for less and less sophisticated and professional multifamily owners. You do less of it as they are more professional and sophisticated, though you do want to be able to kind of compare notes on higher level. This is how I'm underwriting. These are my basis. This is where my notes are coming from, comparing and contrasting that, making sure there aren't big gaps in those, because that could impact value. And then, if we're working with the kind of profile that you're describing would be, they have some experience in multifamily, but maybe it's been 20 years since they bought something, or they inherited something that mom or dad bought, but they want to buy something new. So they may have some experience. Sometimes, and certainly kind of early on, would work more with people that have no experience in multifamily. So you're doing a lot more. You're connecting them to different people. We always have to be careful as brokers, because we can only do so much. We have to represent that we're not attorneys, accountants, property managers even, but, giving our expectations and saying, this is what it should be, but here's the professionals for you to talk to confirm it. Because again, ultimately, you're buying this, you're signing the documents. At the end of the day, when we walk away, you got to own it and operate it. So it's you who has to be comfortable with how it operates.
Yeah, that's a good point.
But yeah, we'll as needed, we'll dive in on all that stuff. CapEx items, you need a budget on what that roof replacement would be. Here's 3 roofers. Have them take a look at it. You're going to get it. You're going to get the numbers from the roofer. So it's a third party, adding more to that kind of transparency and buffer of liability.
Okay. And, one of the terms that people like to talk about, it's almost, in some ways, some people might frame it as gloating. They're like, oh, I bought this deal off market, right? When you hear that term, what comes to mind? What do you think about that?
What do I think about off market? Everybody loves off market. There's a story to be told. There's it just implies that you might be getting something that others didn't have access to. There's a little bit of a potential premium there. If it's a terrible deal overpriced, it doesn't matter if it was off market or not.
Yeah.
But let's see. Yeah, off market. From a seller standpoint, oftentimes it's complex, and especially if you are, a lot of times it's families that end up owning, operating, or inheriting multifamily assets. They can be small, they can be large, but there's 15 line items on our categories of profit and loss. Each one of those, has 10 to 15, potential kind of categories on each one. Everything's different. Your insurance premium could go up. Your manager could move the next day, and you can't find one unless you pay them, 20% more. Your debt is coming due, and oh my God, when we go to refi, we got to put cash in. We don't have cash. This is going to take us under.
Yeah.
A lot of very complex scenarios that can be overwhelming. So an off-market offer for some sellers is like, please just bring me somebody who's going to take this off my hands in 60 to 90 days and give me a fair price, give me a good enough price. If I take this thing to market, it runs the risk of my on-site employee who's been there for 20 years, who I never want to see leave again, leaving, or my residents seeing that it's on market and they stop paying or they go away, or there's all these different kind of layers of that. So, but yeah, from a buyer standpoint, off market could imply, and when it's in a gloating scenario or a positive scenario, it implies that, hey, we got this deal before the 30 or 40 other buyers got to see it, and we got a good deal,
Yeah.
unquote.
And that brings up some interesting points. So, like, obviously, as a seller, if you're not taking something to market, you might be leaving money on the table. If you've owned the building a long time, it may not bother you. But, you're in this situation. You've got a book of clients, right? You've got this deal that maybe is off market that you're listing, right? How do you decide who gets to look at it first in your book of clients? Or do you just do a like, how is that information disseminated? Does it vary by deal, or are you like, hey, these are my top people, I'm going to bring it to them first? Or, because it goes back to the relationship part of, that somebody has with a broker.
Yeah, it does. And brokers are talking to so many different groups and investors, and some of them, they'll be the same individual that you'll talk to for 15 years. Some of the companies open and shutter. Some of them change shops. Mm-hmm. So, and then some of them have access to capital for the right type of product at the right market cycle, timing. So it changes. And I always like to think it's kind of in a 3 to 5 year timeline. You'll do deals with a consistent group, and they're looking for a consistent thing for that period of time, and then some factor changes. Or there's no more rent growth in this market, so we're not looking here anymore, or the debt market changes and these don't pencil anymore, so we're not looking there anymore. So, like, if you're looking for exclusively garden style deals in suburban markets, and I have an off-market deal in urban Portland, I won't call you first. It'll be the one that I've been talking to that has been looking for that deep basis discount urban deal. So it just depends.
Yeah.
And also it helps who either is most actively calling you or you just have a close relationship with. So.
Sure. It's kind of like out of sight, out of mind. It's like marketing of any kind, right?
Yeah.
So what about regulations? So, you happen to be playing in a market with a lot of regulations. How much of that are you trying to prep clients for versus how much are you kind of expecting them to know about these rules? Because I know when they first came out, there was a few people that were kind of blindsided. And I'm not saying this is the broker's fault, but they were blindsided by, the rules on Portland Relo or end of tenancy notice limitations for, no causes after the first year. So how do you see your role in that, and how do you, kind of navigate communicating that information?
When the significant slate of regulatory changes started coming in 2015, 16, we stayed we were very proactive in educating our clients on what these changes were. As time has gone on, certainly from 2018 to 2022, that environment was changing rapidly. There were a lot of changes, and it kind of morphed into the story of you really need a professional property manager, or you're going to have to be, becoming a landlord attorney if you're, an owner manager, to keep track of these changes and make sure you're not, stepping into significant liability. So now things have somewhat settled. There's murmurs here and there of things, and for the most part, at least at this stage, the groups that we're talking to, they're pretty well aware of the regulatory changes, and we kind of rely on property managers to give us updates or attorneys to give us updates. And every, there's municipal, there's city, there's county, state, differences between states. So we just have to be aware of them, and then in pertinent times, bring them up. But again, it's up to the buyers to make sure they fully understand all of that. We're not attorneys. We can't, guide them through and keep them away from all liability.
Yeah, that makes sense. What are some common, pitfalls or mistakes you see investors make?
Good question. Common pitfalls, that's a tough one because it changes pretty dramatically. I'm trying to think of an overarching one, like through
like a
cycles,
theme.
like a theme. I mean, probably not putting enough down, which, many people would think that's a silly statement, because so much of real estate investment, especially in the 5th through, 10th inning of a cycle, there are people who are either, don't own outright a significant portfolio, and they're trying to go from 0 to 60 quickly. So they're putting as little money down as they can.
Leveraging to the max.
Yeah. But, the music stops always at some point, and usually, later than you expected, but and then all of a sudden, the music stops. So yeah, I mean, it's definitely, patience is a virtue, as they say. And I'm trying to think of anything else.
Well, how much down? Because I think that's a really good point, and I think it's an often overlooked point, especially, over the last probably 10 years. Now, most notably, maybe the last 2 years, people have paid more attention to that. But what do you think is a reasonable amount that you would say, hey, this is what if you're looking to hold this is how much I think you should put down?
Yeah. I think the best answer would be the amount that comfortably covers your debt service when you stress test it, in a few different arenas. I mean, generally it's 40 to 45% down. It's a factor of cash flow. It's a factor of interest rate. That may change a little bit. Some cases it could be 50%. Some cases it could be 30, 35%. But I think mainly just, stress test some components, and that is tricky because you could get lost in the weeds stress testing all of the potential downfalls, the pitfalls.
Yeah.
Don't just stress test the upside, because then of course you're gonna jump right in. But yeah, I mean, if you never buy it, then you never will experience the upside. And we keep making babies, and we certainly are making more land. So I think the long-term approach is always better. But I'm sorry, I don't know if that I'm totally off track on your question.
I think that's the thing, is there's a lot of people, that we've seen less in our market, although maybe you have a different perspective, but certainly we've seen as a trend where they don't have deep real estate experience. They're social to get at raising money. They may even have access to capital. And, they were buying stuff, and, they got into the business for the first time maybe in 2020, 2021. And that really kind of colored their vision of how things go. And then now, 5 years later, when some of these loans are coming due, they're in a really bad position. So I think it's important because, real estate over the long term, if you can hold it, you'll be fine. Mm-hmm. Like, that time will solve all problems in real estate. But if you don't plan for contingencies, you can lose everything, and you can lose not only the building, but a lot of times you're signing personal guarantees on loans, and then, you're even further down into a problem. So I think it's an overlooked point, and I think people sometimes are focused on, getting rich quick, and it goes back to, again, to your piece of advice, which is, hit a double, not a grand slam. There'll be an opportunity for a grand slam, but like while you're building your foundation, do boring deals.
Yeah.
You know,
Do boring deals, do small deals, do deals that you can keep during the downside, I think, to your point. And, I do think for groups that are looking, retail investors that are looking to get into multifamily or any kind of commercial real estate for the first time, if you're dreaming of the empire, think about it as coming for your kids. Like you may see it in your 80s.
yeah,
But it's a long game, and you don't get there if you lose it all because you went too hard
yeah,
when you shouldn't have. There are times in the cycle where you can get in and do the short term and do the intense business plan, and that's probably in about 2 years. It's early cycle, but not too early to where you'd miss out on all the upside,
sure,
and you lose it before then. But yeah, it's a long term game. It's patient.
cool. Well, maybe you can share with us maybe a memorable client story that you have, something that story that really comes to mind. Either it could be a great thing where it's like, hey, they really hit it out of the park, they won, I was super happy for them, or it can be like, man, this was a lesson in what not to do. Do you have anything that kind of like sticks out in your mind that you think would be worth sharing, good learning opportunity for people?
No, I don't. No, I don't ever want to break confidence.
Sure.
I think it's been exciting to see a lot of people grow, their family's business or their internal business. I don't know. I think less is more. Don't go put gold-plated, fixtures in an apartment building that has nice, clean, new fixtures. And I guess, how does that relate to your story? Just seeing clients that have like followed that and stayed diligent to, hey, we're know what you're offering. If you're offering a B or C class apartment living place, doesn't make sense to, dramatically improve the property.
Yeah. Like don't project. Don't treat, I mean, like obviously you want to respect the building. You want to do nice things.
Projection is I think a
But,
part of that. Totally.
yeah.
It's
It's like, well, would I want to live here? And I think that's a good standard to a degree.
yeah.
But at some point, you want to match your amenities with your asset class,
Yeah.
right? And your
Yeah.
finishes with your asset class.
Absolutely. And those are the ones that, are the success stories in the game that,
Yeah.
yeah.
Cool. All right, we're back. Sean, thanks for joining us again. One of the questions that I have is there something that you feel like that clients don't know that you wish that they did? Meaning, it's a frequent conversation you're having with people. It could be, guiding them through the emotional roller coaster of buying. It could be maybe something they miss in underwriting. But is there anything that comes to mind that you've just kind of noticed that like, hey, this is just one of those things that when you're with your other broker friends and you're talking, you're like, man, this is the same old conversation again. Is it like, what is it that kind of strikes a chord with you?
I know there are factors like that. I think, yeah, the more sophisticated buyer group, it's, it seems like almost the opposite where they know more than you do.
Is that more on like the institutional level, or are you talking about still also like private equity?
Yeah, institutional or family office.
Yeah.
Let's see. Yeah, I mean, there's certainly there are trends that pop up here and more, but certainly over like a more of a private client investor where they're just less attuned to the way the business works, and so nothing's popping out, I guess, immediately.
Cool.
I'll circle back if I can think of something. I'll come back to that.
Got it. Well, one of the things I want to talk with you about, because it's always a moving target, is a little bit about market conditions, market trends, what you're seeing. One of the things I'm curious, and again, you can add more color to this, but are you seeing more seller financing options out there than you have before, or is that not really shown up a ton? Maybe you could just talk about where that's kind of playing out and kind of the overall market that you're seeing, where it's moving.
Yeah, it's I'm seeing that, but in another name. It's a recapitalization. So a group that for whatever reason, depending on their basis, doesn't want to sell under the current market conditions, they're offering to reinvest into the new entity and it is, in effect a reduction of the amount of money that buyer then needs to come to the table with. They're taking on a new partner.
Interesting.
But so it's that by another name. Seller financing, I think you probably do see more of that, in the 5 to 10 unit space, but it's not been a common conversation that we've had. And then it's just sometimes it's a rare occurrence where there's an owner that has enough equity in a deal to where it makes sense to leave money there. Yeah, oftentimes it just doesn't make any sense. They need to pay off their loan, and they would like to have some, fruits for their labor. And if they're then leaving, a large slug there, it's, in my experience, it's rare. I know it is coming up more over the last couple of years, just as debt gets difficult to acquire and interest rates rise.
So this recapitalization thing, that's really interesting because from an outsider standpoint, that sounds like that would be more complicated than seller financing, right? Because the seller is essentially rolling in their capital into the deal, which is a form of seller financing, like you said. But bringing on a partner is scary business, right? Like you don't know how that operator's gonna, be. You don't know how they handle risk or how they make decisions. So it's interesting. What do you think has kind of prompted people to be comfortable with that type of thing, or what do you think's driving that?
I mean, a lot of it's out of necessity. I don't think you choose to do that. In some cases, in oftentimes it's in existing partnerships. So
Got it.
you have an asset that's owned, operated by one entity, and it's got a couple limited partners, and the limited partners believe in the long term. They don't really need the money. And I'd say more frequently, it's we have an asset that's had a value correction, and we want to keep as much money, bring in a new equity partner to close a permanent loan.
Yeah.
And we're going to keep whatever equity chunk we can negotiate and, whatever sliver we can hang on to hope for upside and brighter days down the road.
That makes more sense. And I think that, if you've got a motivated seller and you've got somebody who is not able to refinance, then that makes a lot of sense. And there may be other reasons too, but
typically they're not able to refinance. So
Got it. So what else is your kind of take on the market? Like what trends are you seeing? That's always what people are trying to do is read the tea leaves and,
Nobody has the answer.
You did.
Yeah, right. Well, I'll give you mine, but it's pretty fascinating everybody has a different thesis, and they're going to place their bets on the table and give it time to see if it worked out or not. There's no clear, at least right now in my purview, there's no clear like untapped market. And I think part of that is more of the broader generational changes that have happened in the last 10 to 15 years, 20 years, where before that, transparency and speed to communicate and speed to execute was so much slower. So you could see these large disparities open up in, let's say, Portland in 2010. Mm-hmm. And even today, we're still the most affordable on the West Coast for a major metropolitan area. But at the time, it was much more dramatic. And you're offering, a really similar quality of life. I'm talking, more of a tenant demand component here. And so I guess what I'm getting at is investors have sought out these areas that offer a high quality of life, that have a low rent, a low set rental rate in the area, that if you go in and you do add some value, that quality of life story will appeal to more residents who either, could move there or are moving there. And right now, post-COVID, we saw people flee urban areas for all the reasons, I think COVID related from West Coast capitals or coastal capitals. Let's get some fresh air. We're everywhere we go, we're wearing masks. So let's go to a house that we got a backyard. Let's get more, now we're working from home and we need a podcast studio. So let's go to, get a 3-bedroom instead of the 2 or the studio or the 1. But that's kind of petered out, and we saw a lot of new supply build to accommodate that. And now that's slowing down. The economic picture is unique. I think there's some sea changes happening that need to play out before we see the long-term economic growth.
Mm-hmm. Are you talking about nationally sea changes, or are you talking about more regionally?
I'm talking about evolutionarily. I think the artificial intelligence is
Oh, okay. Sure.
dramatic in terms of we don't quite know what the downstream effects will be from an employment standpoint. And, this is not my world. It's just a finger in the wind of, listening to what I can. But, what drove most of the development of urban Portland in 2010 was the young, tech professional, as it did within every other city. And, was a clear bubble at some point. And now there's a massive, upheaval in the tech space. So, what are the new major job drivers? We always regionally would rely on Intel and Nike as West Side, staples, major employment hubs and ancillary businesses that they built off that. They're not in the same position they were 15 years ago. But, NVIDIA is investing in Intel. And what does that mean?
That was wild.
Could it be a future acquisition? Who knows? So I think things will change and morph. So to the point of trends, I think we have the demographic trends that the largest cohort, passing through the rental or residential demand timeline right now is millennials, and they're at an age where they want a little more space. And, but there's the balancing act factor of, well, how far out do I go where I still retain access to the most abundance of employment opportunities?
Where do you think, I guess, because there's a lot of unknowns, right? But a lot of people, they underwrite deals 5 years, 7 years, that's pretty typical. That feels a lot closer to where we are, right? I mean, still radically, things could change. Just looking back 5 years, we could see what happened. So that's kind of an indicator. But, for somebody who's thinking about buying a building in the next year, and again, I realize this is going to be very regional or whatever, but I mean, is your general sentiment like, hey, that's probably a good play?
To purchase an asset now?
Mm-hmm.
It's historically the best time ever to buy right now. No, it really is. I mean, we're seeing asset values, and this goes towards the most obvious and simplistic, real estate, not paradigm, but principle, which is when everybody else is over here, you should be buying over here. And when everybody else is bullish, you should be sheepish, and vice versa, bearish and bullish. We're seeing asset values in urban Portland that were from 15 years ago, in some cases more. So you can reach back into time and get an asset value that we know, whether it's 5, 10, 15, 20, is going to be correcting back and, get back on that, average 3% year over year growth. So there will come a time where there's a hockey stick correction. It's hard to see with current politics, but we'll get there.
So it's interesting. Sorry, go ahead. I didn't mean to interrupt.
No. I rambled. Go ahead.
Well, you brought up, I mean, it's a good thing, and because I did want to get your thoughts on the Portland market and Oregon more broadly. Because I mean, you do see values. I didn't realize that they had kind of rolled back that far in some cases, but I've seen cap rates improve for investors pretty dramatically if you're a buyer, right? You're going in cap rate looks a lot nicer than it was a couple of years ago.
On paper.
On paper it does,
The marketing brochure.
Sure. Well, yeah, and then you've got to figure out the debt side, right? Because that's going to determine some stuff. But if you're looking at the NOI part, you're kind of, except for maybe taxes, you got to factor for and so forth. But sure, those buildings, let's just say 15 years ago, they were, X price. Say this building was $10 million, and now you can buy it for 11 or something, right? So you're pretty close to what it was. Some of the things that didn't exist 15 years ago that were, rent control, Portland Relo, fair ordinance. So there's a certain amount of adjustment for that. But I am curious because I don't think it's regulation alone that has caused people to pause on the region. What do you think, in your opinion, is? Like, what do you think has caused people to say, I would rather invest in Boise, Idaho, or Nashville than Portland?
Yeah, I agree. I don't think it's just regulation. It's a combination of so many things that can be summarized in, if you're going to place a bet, if you're going to purchase something that you want to at least be worth what you purchased it for, if not make some return, for the most part, it's hard to trust that investment will increase in Portland. There's way more case studies where the value has gone down, and it's going to take a generation, I think, for that. We need rent growth. We need positive rent growth, and that's a signal that there's demand to live here. But there's so many other factors. You mentioned cap rates, and I made a joke about the real cap rate, let's say. But as an example, new construction that would have traded at the peak in the 360, 370 a door range.
Wow.
Yeah.
That's a big price.
Now being 180 to 200,000 per unit, so about half. And the cap rate, you would think, would be a 5.5, 6, which is where things should be. And you're right. Generally the expectation is the cap rates are a little better, unless there's demand for that asset, and then that's it's who wants it the most. But for that urban product, because of the dramatic increase in repairs and maintenance for a building, because of the much needed increases in payroll for people who are on site fixing and leasing units, and overhead for keeping up with regulatory changes. You run a management company, somebody's got to do that, right? You couple that with insurance and taxes, all the while you're either having downward rent growth, so not growth, plus concessions, plus, and this I can only quantify as just this anti-landlord sentiment that has popped up. But in 2019, 2020 especially, you started to see people just stop paying rent entirely. And of course, some cases that was out of necessity and they just couldn't. And that's a tough situation to be in. Oftentimes, these are people that would go from building to building, run up $10,000. And because of the tight regulations, it was hard to get them out. So what I'm getting at is it could be half the value. So you'd think that the cap rate would be better, but it's still a 4 cap. It's a 3, 4, 5 cap.
Yeah.
So it's a weird combination of a lot of things. The regulations are, I actually, I'm going to get a lot of crap for saying this. I actually kind of like what we have in place now. It puts clear parameters on, when it's inevitable that at some point we'll have significant rent growth. We are not building enough housing, and we still maintain enough, positive quality of life, borne on the backs of the community and the business owners, certainly not, the policymakers. So when it is double-digit rent growth, when it is 20% rent growth, it's nice that there's going to be some cap there. There's not a cap in expenses. I get that it's not an easy thing, but I struggled with the regulations for years just because all of a sudden I'm selling an asset that is either worth less or is so much more complicated for people to wrap their head around. Why should I buy here? But it's pretty clear. It's pretty straightforward. If it gets more and more onerous, it's only going to drive to less and less investment in housing, and that shoots us in the foot over the long run.
Yeah. Are you seeing, because another thing that a lot of times people don't think about is insurance, right? And the age of buildings. And, Oregon, in an Oregon way, has made insurance, underwriting insurance more difficult. So you've had a lot of people leave the market, and the ones that have stayed have started to, at least that's what I've heard, lean more towards, product that was built, post 1990. Are you kind of seeing that in the demand for the products that you see buyers are looking for? Has that started to show up in terms of deals that are people making offers on and getting closed?
Yeah, that hit in heavy in 2023. It started before that, but I think especially 2023, and that was at the same time of a massive correction in the capital markets, and in October 2022, 50 basis points increase by the Fed, and so that led to a 90% decrease in sales that year, depending on what metric you're looking at. And it was another component. It was just Portland developers always say developing in Portland is death by 1,000 cuts. It's not any one thing, it's all the things combined. And that's death by 1,000 cuts trying to sell a building. You couldn't do it. It didn't make any sense.
Yeah. But it sounds like you've seen that improve.
It seems to have stabilized.
Okay.
Yeah. It seems to have stabilized. I think there have been alternative groups that have come in to get the older product.
Well, Sean, those are all the kind of formal questions I have for you. I've got a couple more casual ones so that we get to We get to know Sean Worl a little bit better. We always like to wrap up the episode and give the audience a better sense of who this guy is. But I just have a general basic question for you first and foremost is like, what do you do to unplug, right? Because you're obviously grinding, you're making calls, you're hustling, but you got to unplug sometime. What do you do to kind of recharge?
Yeah, I tend to do different things. Like I feel like I go through different seasons of a hobby or an interest, and one that I have found to be my best for unplugging is some form of carpentry work or like fixing my house. We've always bought houses that are 60, 70 years old, and I'm probably too cheap to do it. Or just I'm too like, I don't want to, hire someone to come in and do it wrong.
Sure.
I'm trying to get better at that, but I really have always loved, one, you do it yourself, and then you get to walk by that thing that you did and, feel, look at that, I did that, and It's great. It's exactly how I wanted it too. Golf, I'm getting more into golf. I have 3 daughters, and they're everything. They're the center of my life, so just spending time with them. They're 3, 7, and 9, and at ages that are really fun to introduce them to, all the new things.
Yeah.
We're knee deep in the practices right now.
Cool.
Yeah, hanging out with friends, going to do good stuff.
I like it. Well, you mentioned obviously you've got a family, you've got 3 daughters, and what is something that you want to give your family, as part of being, a husband or a father, something that you want to give them that you feel like you didn't maybe have growing up?
You started that question. I immediately thought of something, and it probably resonates all through that question in terms of did I have it or not when I was growing up. But more than anything, I want them to just believe in their own capabilities, believe that they can do things. I want them to, feel like they have a place in this world, that they can make a positive impact. And I had that somewhat, but I feel like the Worl clan, we have our doubts, we want to hedge our bets. So yeah, that'd probably be it.
Okay. And then final question here is, what's something on your bucket list that you are committed to doing?
Something on my bucket list that I'm committed to doing. I want to travel to quite a few places with my family. That's one. I started writing a story during COVID, and I want to complete it. I want to finish it and just say that I wrote a story. So
there you go.
Yeah, for those
Cool.
2 things.
Those are great. Well, thank you, Sean. Really appreciate you coming on the podcast. If people want to reach out to you, maybe they want to buy a building in this market, and you're definitely the guy we'd recommend, how can they reach you?
Let's see. You can Google my name, Sean Worl, SeanWorl. You can find me on my Colliers website.
Cool. Well, great.
Yeah.
Thanks for coming on, Sean.
Cool. Thanks for having me.
Appreciate it.
Yeah, good to see you, buddy.
Bye.